Yeah, bridging that gap is huge. And, one of the things that kind of comes to mind when I think about having that non-qualified bucket to live off of pre-59.5 is not making that decision at 54.
Yeah, right.
Right? Like, there's some planning that needs to go into.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Isaac.
Hello.
And John.
Good morning.
And it is 2026, so
Unreal.
New year, kind of crazy. It sounds like futuristic to say 2026.
Yeah.
But hey, we hit 1,000 subscribers before the end of last year, which is awesome. We sent out a video kind of celebrating that, thanking you guys. So we really appreciate it. Appreciate everyone out there that likes and subscribes and submits comments. If you haven't subscribed, we would love for you to do that. So jump on the bandwagon this year. We're trying to come out with better and better content, getting better, making the content. And so we know we've got a long ways to go, which is exciting. We've come a long ways over the last several years, but we're excited about where we're going to take this channel and some of the new videos John and Isaac are going to be doing this year. Eli's data briefs are going to continue to get better. Hopefully the podcast gets better. So a lot of exciting stuff. Appreciate you guys coming along with us. Hopefully you enjoy some of it. And as we always say, send us an email or comment if you have any thoughts or ideas or topics or questions. We like going through those and getting ideas of what to talk about moving forward, and which is where we got one of the ideas that we're going to talk about today.
If each of you could just ask 1,000 of your friends to join.
Yeah.
So that would kind of get
That
us
would really
started.
speed this up.
Yeah, it would speed it up.
So 2026, it's crazy. We're here. As you know, the years just fly by. So I feel like we're just starting off 2025, but a year has passed. And so the first question that we're going to talk about this year, 2026, is, what should you be thinking about? How should I be planning if you're planning to and desire to retire before 59 and a half, right? So real quick, because we get a lot of feedback on this from time to time of using acronyms and things that we're not explaining. This is not an acronym, but where does the age 59 and a half come from? It's a random age, so why is that something that we reference or something that people in the financial industry reference? That's the age that you can start taking income or distributions out of retirement accounts, tax deferred accounts, without paying an extra penalty, right? So the distributions are likely taxable if they're coming out of tax deferred, but if you take money out before 59 and a half and it's not one of the exceptions
From your IRA.
401k,
Right.
then you're going to pay an extra penalty.
10% penalty.
So oftentimes, unless you've planned ahead, that's kind of the earliest
Yes.
people think of retiring because they know they can start accessing those accounts. Okay. So that's where 59 and a half comes from. It's literally the day you turn 59 in 6 months.
Yeah.
So what if you're trying to retire before that? What should you be thinking about? How should you be planning? John, what's a couple things or one thing that comes to mind when you think about this?
Well, there's 1,000 things come to my head, but one thing, like we're meeting with a lot of younger clients, 30s, 40s now, that do want to retire early. I've noticed that trend is happening, right? People do say, I want to retire 55 or 52 or whatever. And we've been this incredible market run and so on, and a lot of people have the ability to do so. The things you should consider, health insurance costs are going to go skyrocketing from the time you retire and don't have company-sponsored health insurance until you're 65. A lot of people forget to consider that. The other thing, when you're saving, we've been told to put all our money in our 401ks and you get the company match and all that stuff and just save your 401ks. But I think there's an argument, and a big argument, to have 3 buckets of savings. Your 401k, yes, obvious. Roth IRA, and if you can get your Roth through your 401k, even better, which a lot of companies now have that. And then qualified money, just money that you invest outside of IRAs, which if you build those 3 buckets, the bucket that is the non-qualified could help bridge the gap if you want to retire before 59 and a half, without having to exercise all these crazy IRS rules that we'll talk about that can create confusion and they're complex and so on. You can avoid all that by, having
enough money in the bucket.
Having different buckets of savings that you've done over the years to prepare for this.
Everybody always talks about, diversification from an, asset allocation perspective, right? But there's diversification in terms of, where your assets located, what types of accounts are they in. And so the more you're diversified, the more you have money in tax deferred, tax free, non-qualified, and the more balance you have there, the more diversification you have, the more flexibility you have, the more options you have. And it's really hard because going back to the 80s when the 401k came into existence, for the first couple decades, the 401k is the thing. It's all you heard.
Yep.
Hey, max out your 401k, save as much as you can. You get to retirement, you can live off of it, and that's great. But if that's you and you want to retire pre-59 and a half, there's some ways to do it that we'll talk about, but you just don't have a ton of options, right? You're kind of pigeonholed into a few ways to do it.
Yeah, bridging that gap is huge. And one of the things that kind of comes to mind when I think about having that non-qualified bucket to live off of pre-59 and a half is not making that decision at 54.
Yeah, right.
Right. Like there's some planning that needs to go into, hey, maybe you're in your late 40s, even 50. We've even with some clients lowered their 401k contributions to start building up a non-qualified base, knowing that they're going to need that money.
Because ideally you don't have to completely deplete that bucket.
Yeah.
To get you to 59
Sure.
and a half, right?
Yeah,
because
exactly.
ideally you maintain a decent balance in that non-qualified bucket well into retirement to give you, flexibility of how to manage your tax situation. Where are you taking income from? So let's say you're wanting to retire pre-59 and a half. You haven't planned well in advance. Most or all of your money is in IRAs or 401ks. What are the options that you have? So I'll mention the option related to IRAs. So there's a rule in the tax code that allows you to access funds out of an IRA pre-59 and a half if you meet certain, requirements. And it's called the rule 72T, right? And so a lot of nuances. It can be kind of tricky. It's not, I don't want to make it sound overly complicated because it's not. We've done it with clients.
Yeah, we've done it.
But it's just, again, you're having to play by their rules, which just...
It's restrictive.
It's
very restrictive.
Which you never like playing by someone else's rules.
No.
And so, but it allows you to take equal systematic withdrawals for a minimum of no less than 5 years or longer of the same amount or until you reach 59 and a half.
Yes, with the longer of the two.
The longer of the two, right.
Yeah.
Yes.
So if you started at 57... you'd have to do that rule 50,
for at
rule
least
72 till 62.
Yeah,
for 5 years.
For at least 5 years.
If you started at 51, you'd have to do it till 59
and a half.
Yeah.
Right. And so it's got to be this systematic, kind of regular, recurring withdrawal. So you can access IRA funds pre-59 and a half if you follow the 72T guidelines, but you're playing by their rules and there's not a whole lot of flexibility.
And the number is determined, the IRS code, whatever, determines the amount. So I can give you an example. I had one that retired at 55, exercised the rule 72T. The percent was like 4 point something percent of their total balance, and you can't change that. You can't take more than that. You can't. You can. I guess you could take less than that. I haven't thought about that. You can't take more than that. So they were, whatever that number was what they got for that 5 year period. It didn't adjust. They couldn't change it. And if you took more than that, you busted up the 72T.
Yeah.
And then you're penalized on the stuff you took out before. So it's very important to know. Like if you, and this is the point about that I've done that once in my career, one time rule 72T, and it worked. The gentleman made it through the 5 years and it was all fine, but it was not ideal because they needed to do things and they couldn't access. All of their money was in their IRA and they couldn't do some of the things they wanted to do until that 5 year was up or they'd risk paying a massive penalty. So that, it's restrictive. We'd like to find other ways, and that goes back to the reason why you should have other buckets.
Just plan ahead.
Yeah.
So that's the way you can do it if your funds are in an IRA. Isaac, what are your options if you've left the funds in a 401k?
Yeah, absolutely. If you leave the funds in a 401k, there's a thing called the rule of 55. So if you're 55, if you have to work at the place until you're 55 and you retire, you can actually withdraw penalty-free from the 401k. This doesn't work if you've already rolled it over to an IRA. If it's an old employer's 401k, it doesn't work. It has to be the workplace that you just retired from. You can pull out of their plan.
And their plan has to approve it.
Okay.
In other words, I've had one where that worked, and I've had one where the plan didn't offer it.
Really? Yeah.
Yeah. So the plan can,
push back
clip
a
your
little bit.
wings on that if you don't,
Yeah.
if it doesn't offer it.
Just making sure that you have an understanding of the plan rules and things like that.
So it's a similar type rule but there's differences, with are the funds in the 401k or are they in a 72T. But the objective of both are still to give you some flexibility to be able to touch the tax deferred, funds before you get to 59 and a half. You just have to go about it in different ways.
Yeah.
The
rule of 55 is better simply because you're not restricted to the amount, and
Right.
there's not a 5-year, restrictive policy, but it's the same concept.
Yeah. So, but like we mentioned, early in the conversation, way better to start. The earlier you start planning, the more diversification you have in terms of where your assets are located. You're going to have a lot more options. Both the Rule of 55 and the 72T are both valid, good things to consider. But typically they're kind of a, means of last resort because you haven't planned to take care of those income needs in other ways. Anything else? So we talked about health insurance, huge deal. Knowing what that's going to be, having a good idea of what that's going to cost, knowing it's going to be a lot more than you're used to paying. And if you're retiring early, that can be for a long time. I mean, if you're retired at 55, you don't get to Medicare age till 65. You got 10 years.
And well, the way stuff is happening in Congress and so on, and I know if people are paying attention, but it's a mess right now. The healthcare story is a mess. Like they're trying to fix it, but who knows? So that becomes a bigger problem for people. It could be more expensive than they even thought, and that's the danger of that wild card of health insurance. So, I mean, I always say this on health insurance as well, though. I've had people say they've had plenty of assets, they've done all the right things, and they're afraid to retire until 65 because of health insurance. Yeah. And I think it's a misconception that health insurance is like $10,000 a month or something. It is not, right? You can't, again, I think it's all about planning. It's all about getting all the answers of everything before you make a decision, but not making a decision before you do all the planning.
Yeah.
Does that make sense? Because it's not as bad as, it can work. You can still pay for the health insurance. It's not the end of the world. It is more expensive typically, but it's not the end of the world.
Anything else that comes to mind when you think about early retirement?
We're living longer.
Yeah.
So a lot of plans
just
have
longevity
people
risk.
passing away at 85 or 90. Now it's 100.
Yeah.
So your money has to last longer.
Yeah.
So you just have to think about that as well.
And planning ahead with the way you're managing your debt. Retirement is a lot easier to fund if you don't have debt payments, right?
Oh, gosh,
on your cars, your house, and so maybe needing to plan ahead to accelerate that. If your retirement age went from 62 and now you're trying to retire at 55, how do we accelerate some of these debt payoffs if it makes sense? To try to do that before you fully retire.
Yeah. Keeping your expenses reasonable to what's coming in versus what's going out, and making sure you're making it to 100.
Exactly.
Yeah. Yep. Okay. So, kind of hot topic right now with everything going on with things going on in the market. Not going to get political here. Going to talk about kind of how the market reacted, and kind of what we think might happen over the coming weeks or months. But had Venezuela, the whole situation there, coming into yesterday. I was really curious of okay, what is the market going to do?
How it's going to react.
And Monday we had a great day.
Yeah.
Market rallied. All the major indexes were up in a pretty big way. Was that surprising to you?
Go ahead, you go.
To me, no, because of the smoothness of the operation, and we don't have ground troops there. It's not a Vietnam, so to speak, right?
Yeah.
It's like we took care of business, miraculously so, and now it's just a matter of I think sometimes the euphoric potential of we've got all this oil that's now going to flood the market, that needs to be tampered, right? Because it might take years to get this stuff developed correctly. But I will say this. I was listening to the radio. I was driving from Florida home to Arkansas, which is a long drive. And I was listening to a lot of this stuff about Venezuela. And so you hear all these different stories, and some of you want to believe it or not. But think about this. They were estimated their reserves were at 303 billion barrels, which is a massive amount for the world to. And, of course, the only way they were using that is illegally sending it to other places around the world, which we were blowing up their ships or whatever, taking over their ships. So this is going to be a big deal ultimately for energy prices, and for the Venezuelan people, it's fantastic. The market, I think, reacted quite right simply because it was a successful mission, and it's ultimately going to end well for the world. Like this was good for the world.
It's a generally positive thing overall.
Yeah, overall.
Even through the Were you
I
surprised?
think so.
Yeah, no. Kind of what John hinted at, because it wasn't a drawn out thing. I don't think it gave people time to worry.
Yeah.
Right. Like a lot of market volatility comes when we have to think too much, and we sit there and what if this happens? What if that happens? And it was swift and it was successful, and yeah.
Now the other thing that we can take false hope in is that it's going to be smooth from this point forward.
Right.
It's not going to be.
Right.
It's going to be.
It's gonna be long. It's gonna be a long process to get the. To your point, it's gonna be a long time before the Venezuelan people or whoever
Anybody,
the world starts seeing the benefits of that, and certain things have to continue to go well.
Mm-hmm.
Right?
Yeah.
I mean,
the person that took over, the vice president, just 2 or 3 days before Maduro was taken, she was very pro Maduro, you know, and now she's suddenly kind of switching gears, right? I mean, and that's stuff like that you can't trust. You don't know 100% how it's going to go, and you just you pray and hope for the Venezuelan people that works out exactly the way it needs to and should for them, because they have been under a thumb, if you will, and I hope that all works out well for them, and it's a good start, right? It's a good start.
Well, the market's up. Markets are green this morning.
Mm-hmm.
So it's been a good start to the year. We've had a rally in some of the semi. Conductor chip companies here at the beginning of the year. I know like Micron is up big year to date. There were some names that have rallied in the first few days of the year, just with a shortage of chips and the demand still high. I mean, it is crazy.
Is technology ever gonna stop?
We've had a really good few years here, right? We had we had a bad year in 22, and then 23, 24, 25 been good years. And so I think you get to that point where you're like, well, 3 good years in a row.
Can we have a 4-peat?
Oh, we do. Yeah. But it's like, you go back and you can look at plenty of periods where it's like the market did really well for 7 or 8 years, right?
Exactly.
I mean, you had the 90s. You had different times where the market did really well for extended periods of time. So who knows how long this bull market will go on for,
Mr. Pessimistic is more optimistic than I've been in a long time.
Yeah.
We're going to have the highest tax
sell
refund
everything.
the most tax refund opportunity this tax season, right?
Yeah.
Which brings money back into the economy. It really.
I mean, the extra deductions for seniors that started last year that go for the next few years. That's a huge deal. It's going to save people a lot of money. So a lot of the tax benefits that were passed last year, people are going to start really feeling them now,
and they're going to spend them.
Yeah,
we've
absolutely.
taught. If anything, we've learned is that we don't save, we spend.
Well, some of the biggest concern out there has been, inflation. Things are getting tight. The labor market's tightened. But if people get, tax refunds, their payroll or their take-home pay goes up a little bit because taxes are more favorable. That helps them, continue the current spending and absorb some of that inflation for at least a bit longer. Who knows how sustainable that is for, but yeah, I think this bull market has legs.
I think it does too, and I think the AI stuff is just beginning.
That could age really poorly, by the way. But
it's
I do. I think.
No, I agree.
I mean, we've got a lot of anything could always come out of left field. You've always got the tail risk, right? That of the unexpected, out of nowhere kind of things in events and shocks. But everything we know right now, it's like there's no reason to think that the market couldn't continue to grind higher for a while.
I'd love to see the lower middle class and lower class, like that part of our society, rise up.
Yeah.
And I think that there's some policies in place that will help that happen. And if you see that happen, if you start to see that increase, like jobs are better, pay is better, opportunities are better. If we start to see that happen, I think you could have a continuous run. I mean, that's kind of what I've been worried about is like that middle class and under being able to pay their bills. And heavy, which we have some high defaults and so on going on right now. But if we can somehow turn that around, I think that's the last little thing that worries me. That man, if we could get that going, I think it's the sky's the limit.
Yeah. All right. Any parting thoughts or words before we wrap it up for today? First episode of 26.
It's playoff time, NFL, and it's college football time. Isaac's wife is a Oregon Duck.
An Oregon Duck fan, and so we actually have tickets to go to Universal Studios on Friday night when the game is happening, and I think we may not be going to Universal.
He has a private Universal Studios
the only reason
option.
the only reason John even mentioned NFL at all is because didn't you win?
He won our fantasy
Yeah,
football.
you won our
Oh,
fantasy.
did I win our
Oh,
fantasy football league?
stop.
Shut up. Yeah, but it is a fun time of year. You got college basketball conference games
College
starting.
basketball's awesome. Yeah,
You got
great time of year.
college football playoffs. You got NFL playoffs.
The Masters is only 3 months away.
Yeah.
They keep advertising.
We need to
3
make
months
sure
away.
give our wives a schedule of every weekend that we're going to need off to watch all these
Let me know how that goes.
events.
Yeah.
Yeah, tell me how that goes. If Oregon wins the national title, you probably have some
Hey, do
reprieve
whatever I
for a
want.
couple of
Yeah.
months. Yeah.
No, it is a fun time of year. Market's off to a good start. A lot of things to be excited about.
Excited
for
about.
26.
Yep.
Yeah.
Happy.
So, like I started the show with, we just appreciate you guys. If you haven't liked or subscribed, we invite you to do so. We'd love for you to jump in and ride along with us and give us feedback or comments of ideas that you have of how we can make this podcast and the content that we put out even better. So, appreciate you guys. We look forward to seeing you next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.